Hey guys, my name is Ruben, and in this video, I will go over how to create a near perfect, in my opinion, trading and investment income plan. If you're new to trading or investing, I will go over also the different asset classes in trading and investing. So I'll go over stocks, futures, forex, options, and what may be the best asset class for you, depending on what your goals are. Whether it is you're trying to replace your income or come closer to retirement. I will explain kind of the different asset classes, how they move, and even based on your personality, what might be the best ones to get you closer to that goal. So I will also go over a supply and demand video off of the same move on the S&P 500. So I will go over stocks, futures, and options on a demand move on the S&P 500 of 250 and a target of 275, and how the different asset classes will give you very different returns and risk reward results based off of the same price action move. So so for that example, we're only going to do $100 risk and see how $100 risk looks like, or what it would look like on the S&P 500 using futures, then options, then the stock itself. I will also make a theoretical trading plan using a more average person. So and what I mean by that is like not a hedge fund. So when I was trading and investing in the markets for income, I was making $500 to $1,000 from day trading options from a $10,000 account. But that was with the goal of replacing my income. And then for forex, I used for something else, and then futures for the biggest moves. That's my personality. But when I started to make models for a hedge fund, and we were doing a 10 to a $20 million profile, the goal was no longer to make, the goal was very different. So the goal for that was to outperform the S&P 500, and not just outperform the S&P 500, but to get a 15 to 20% return year over year with a maximum drawdown of 5%. So the strategy and the goals for that was very different than for myself day trading equities or day trading options or forex. The goals, and then because the goals were different, so were the trades and the style of trading that was designated to that account. There was also liquidity differences, because it's very different to fill a $20 million position than it is to fill a $2,000 position. So those were the differences, and it became very, very quickly obvious to me how much more important a trading plan is for someone that's even just getting started or who's already experienced. Because to accomplish any of your goals, it's my opinion that the best way to do that is to, the way you eat an elephant, you eat it one bite at a time. So saying that you need $2 million in retirement might sound outrageous to some people, but then when you divide that by the trading days, and you divide that by the trading years and the trading months and the weeks and the days, it becomes a lot more feasible to get to that goal. So for the intent of this purpose, for the intent of this video, we're going to make a more average kind of profile. So we're going to say that just for easy numbers, here's Excel, and I've kind of programmed and laid out all of the numbers. If this is something that you're interested in getting or looking into, send me a message and I will send you this, and then you can adjust it to yourself. So for this, I'm going to say that, the goal here is, thinking with the end goal in mind, is to retire at 65, right? So that is the primary goal of this profile. So I'm going to go ahead and go into Excel and put in the retirement age as 65. That's the goal. The present income for this person is, let's say, $100,000, and we're going to say that for easy numbers. So 100,000, and the monthly retirement income that they're going to get. So what I mean by that is the Social Security that they're going to get is going to be, let's say, whatever the average might be right now. So let's just say $1,250 a month they're going to get in Social Security now. So that's money that they're going to have coming in no matter what. Let's say that this person wants to spend 20 years in retirement. So they want to retire at 65 and they're going to live at least to 85, right? So we're being kind of conservative with that. So we're going to go ahead and put 20 years. And let's say that the present 401k account is $100,000. So with $100,000, we're going to try to close the gap using trading and investments plus their existing income to bridge the gap of retirement for 20 years, whatever that might look like. So we're gonna go ahead and put the present 401k value is 100,000, again for easy numbers, and years until retirement. And what I mean by that is, so let's say the person's 45, so they want to retire in 20 years from now. So between today and 20 years, they're going to want to meet that goal. So we're going to do 20 years again for easy numbers. And so that gives us a deficit amount of $1.9 million, right? So for a lot of people that might sound really, really scary, but because of the leverage you have in trading and investing in the markets, the liquidity, which you don't get in real estate, it is my personal opinion that trading investing in the financial markets is the path of least resistance to get you to your income and retirement goals, or to wealth or what have you. The next thing we're going to have to do is figure out what is the asset class that matches your schedule, your personality, because it's, as someone who's been trading and doing this for over 10 years or almost 10 years, it's I think the most difficult part. So I'm a big follower in a rules-based strategy. I'm a big follower of Sam Seiden, David Warner, Jody Wong. I'm an OTA student. But one of the challenges I think with trading and investing in different asset classes is that they all vary quite, even within the same. So let's take futures, for example. If futures is something you're interested in trading, the S&P futures move different from the NASDAQ futures that move different from the crude oil futures. So as much as I believe in a rules-based strategy, and I wholeheartedly believe that you can make a massive amount of money trading the rules-based strategy as depicted by OTA or Sam Seiden, I'm a testament myself. It is my belief that the whole point of a rules-based strategy, if your goal is to be a professional trader or investor, is to memorize the rules to forget them. So what I mean by that is, my previous world is television and film, and I'm also like a very spiritual person. And they would always tell us in TV and film, and this is kind of how I feel about a lot of the spirituality, is in TV and film, you memorize the rules to forget them. So what I mean by that is, I don't want anyone, in my opinion, to memorize a bunch of rules and then they open up the markets and then they're trying to see, am I seeing, does this follow my rules? I want you to, like, for example, in TV and film, the reason they say memorize to forget them is that so that when you're, on camera, you're not thinking about what your next line is because you already memorized your next line. You're only thinking about the feeling and the emotion of the character. You're only thinking about the consciousness of the character. You're not thinking about what your next line is. So that's the same way I feel about trading and investing, is once you know the rules that you subscribe to using, let's say, core strategy, as OTA presently does in early 2019, you're only now focused, because you know the rules so well, on the consciousness of crude oil, because it moves very different from NASDAQ, that moves different from S&P. And then you're finding yourself and your personality and your style in the consciousness of those markets. Like if you're trading crude oil, Wednesdays could be very, very volatile. If you're trading the S&P 500 or the NASDAQ, the first 30 minutes of market open, can be very, very extreme, So knowing who you are in the markets and in the rules that you follow, in my opinion, is very important. But because people don't know what they don't know, that's why I think making your trading plan paired with your risk reward profiles, knowing how the different asset classes move, is so important, along with obviously understanding what you're even trying to accomplish. So now that we've done that, we can see that, let's say we're starting with a trading capital with $25,000. So we're using 25% of the wealth value. So we're starting with $25,000, and the target year profit is $93,000. So again, I already typed in the formula for this Excel sheet. You know, for all the Excel sheet already has the formulas needed to create a trading plan. So let's say that, you know, now we're gonna add your schedule into the mix. So let's say that you work a regular 9 to 5 and you live in Los Angeles. So you work a regular 9 to 5 and you live in LA and you have a higher risk tolerance. That means that you can trade just about every trading day of the year, more or less. So if the target year profit to get you to that goal is $93,000 over the course of 20 years to get to your retirement goal, then and you're able to trade every day, then you have 222 trading days a year essentially to meet that goal. And in futures is very, very feasible to do that. To get explosive gains, it's very feasible to so here we have a reward per trade is at least 100%. So usually we're going to take at least 3-to-1 risk reward ratios. So as long as the trading risk per account is you know, no more than a 2-to-1, you should be fine. But so I'm gonna go line by line here. So we know that the year-end profit, what it needs to be to get us to that, to close that gap. We know that because you live in LA and you work a 9 to 5, you can trade every trading day of the year. But like, let's say you can only trade you know, once a week. So let's say that you know, you can only do 52 trades a year. Well, the risk reward profile now dramatically changed based on your schedule because you can only trade one time a year, you know, one. So then also the asset class will change. So if that's the case, you're probably going to be looking at options too, whereas before maybe you were looking at futures, based on the goal you're trying to accomplish, based on this profile. So then your daily target will be $1,800 on average to get that risk reward. So then that means that, you know, your options risk reward trade only fits in a specific universe. And this is not to intimidate you guys, because this can actually be figured out very, very quickly. So like, you know, Shopify options are very different in volatility profile than Apple, than Starbucks. So, but now you know what you're looking for, and now you know where you want to get started, and you have a compass. So then your desired risk value is 100, which means that you're gonna have to take more or less an 18-to-1 trade. Again, that is possible, and you can program that in. I know with options I can program that in. I've gotten trades that are even 99-to-1 or 50, like, you know, 50 to 99-to-1. You can do that, but now you know what you're looking for based on your schedule, based on those things. So because your maximum daily risk, you decided was going to be 100, you can say it's 200 or whatever. But let's say 100 again for easy numbers. You know that your risk has to be an 18-to-1 if you're only taking one trade per week. So we're going to go back to 222. So then now your risk profile, because you can trade every day, your risk profile is now different. You can take a 4-to-1, 4.2-to-1 risk reward. And then again, the trades per day. I'm sorry, so I should have done that before. So trades per day, if it's only going to be one risk per trade, again, it's going to be $100 risk. Reward is 422. If you're going to do 3 trades per day or 4, then you have a $25 risk and a 105 target. Now, this is where the asset class begin to matter again, because you don't want to be trading just anything. And you also want to give yourself room to be right, like I've said before. So if you're taking a $25 risk per trade, you probably cannot trade futures. Like, because I mean, it's very unlikely that there's any futures trade, even on the 1 minute, that'll give you only a $25 risk for, I mean, you know what I mean? So then you're probably looking at options for Forex, or equities with this account, because your starting capital is 25K. But equities are not going to give you that explosive risk reward. In my opinion, it's going to be Forex, but really mostly primary options that are going to do that for you. And now you also know now your percentage daily risk. So again, all of this has already been reverse engineered for you guys. If you're interested in getting this sheet, just let me know, send me a message. Um, so this is just kind of your general profile. Then I'm also calculating the commissions per trade, because if you're going to be taking 4 trades a day and you're paying $5 a trade and you're doing 4 round trips, you just took 8 trades times 5, you just paid $40 just in commission. So um, again, now that we know what we're trying to accomplish, now we can look at personality types and profiles. So again, this is very, very generic. I'm not recommending any one asset class over another. In fact, I think everyone should aspire to trade all the asset classes, because you will really begin to understand the correlations and what they mean and how they work in different things. So this is the video I was telling you about, just so we can cover that actually right now. It's probably the best time, where we're going to take a SPY trade with demand at 250, target at 275, and we're going to see what the risk, if you're only going to risk $100, what that means in trading the stock, and how much margin you need, or how much account you need to trade the stock, how much you need for the futures contract. If you only want to risk $100, you really couldn't take the trade. I'm just telling you that right now. And in the options was actually the best way to meet that. But now you're going to see how in this video really quickly. So this is the theoretical example I was obviously telling you guys about. So this is the S&P 500 with demand being at 250 and our first target being at 275. This is not this last time the S&P came down in 2018 towards December. This is actually April 2nd of 2018. So it's about a year ago or so. So there's a few ways to trade the S&P 500 here. Obviously, you guys can go ahead and trade the stock, and that would require about 27 or 25,700 or so dollars. If you want to buy 100 shares, that is, as it's trading at 257 right now, 257.30. Not to mention, if you're buying 100 shares and you're only risking $100, your stop loss would be at 256, making the trade likely you would get wicked out, and that wouldn't work for you either. So what you might be left with now is buying the futures contract. If demand is 250 and is currently trading at 257, the futures contract would require you to risk thousands and thousands of dollars for you to accomplish that, as it is $50 a point. And with $100 risk, you're only giving yourself a 2-point chance to be right. So then that leaves us with options. And there's a few ways to trade the options contract here. If we know the move is from 250 to 275 being our first target, then we could consider doing kind of the way everyone else trades options. If you're only wanting to risk $100, you obviously cannot do the futures or the stocks. So what we can do here is do what everybody else does with the options, which is buying it at 250 or selling the put at 250 and getting a $4 credit. The big downside with that is that you're missing the entire move up, and it's just not worth it, especially if you want to outperform the S&P 500. And it's definitely not worth that kind of margin just to get paid a weight for that. So it doesn't make that much sense to me to do it that way. So then the next thing you could do is obviously you could go ahead. Something that I like to do when I'm trading options, I like to trade them like the big banks and institutions. So a lot of times I'll look at the open interest as an probability enhancer per se. So obviously they can do synthetics. So a lot of things can be going on here, but when you're doing when you're trading when you look at the open interest, it kind of gives you an idea of kind of what the banks and institutions might be thinking is happening. Again, I like it as an odds enhancer, but there's a lot of parameters in using it as an odds enhancer, so I would say to just be careful with that. I have a lot of rules and parameters that I use to do it that way. So again, now we're looking at kind of, we talked about in this video with the trading plan and all, that we want to capture the biggest risk reward. Some of you guys needed for the example, I think we needed 18 to 1 or so. So here you can see that the open interest on the OTA or Samsung supply zone has a 43,000 in open interest, which is different than volume. And for this, it would only cost 88 cents to control. Now, this is where options can kind of be molded to however you want it to do, because for the same $100 trade, if the S&P moves up to this price, you're paying for your risk up front. So you usually want to buy your calls below the target, depending what the risk reward is. But here, if it goes from from 250 to or 275 to 280 for 87 cents, or that option would then be worth $500 or so and beyond, as long as you're right on the timing. So this is one of the few instances where you can actually pay up front for the risk you're willing to take in a specific move. And that's kind of what I meant to say earlier, and kind of explain where you need to know not just the the supply and demand, but who you are and the consciousness of the market, and kind of how that move is to you, and where you fit into your risk reward and your personality style. If you're very risk adverse, obviously you can still take a trade like this, but you wouldn't be buying the futures contracts, you wouldn't be buying the stock. The best thing to probably do in this specific instance is to go ahead and just buy an out of the money call, because if you're gonna take the move, if you're wrong, you're gonna get stopped out anyway. So if you're gonna get stopped out on the stock, it's gonna be a couple of pennies below. If you're gonna get stopped out on the futures, is gonna be thousands for a move like this. Here, you can actually, for the same move that you're banking on, you're probably going to only make, if you're right, let's say and target was 280, you might make $500 for the $88 move. But if the market free falls overnight, you're not going to get gapped down in this specific scenario. You're only risking $88, and depending on when it hits target, you can make obviously so much more money. So even if you were going to wanting to risk $500 or $1,000 on the same move from supply to demand or to your target, as long as you're right on the time frames. And when we were at OTA, we learned how different time frames when to expect that hit to move. So I always go 3 times out that. But you can make an explosive risk reward, especially if the markets are free falling, like in the on a violent move down. In my opinion, I think what's happening a lot of times, the algorithms are kind of freaking out a little bit, so they're removing their limit on the calls. So then the out of money calls can free fall in price for those first 5 to 10 minutes in the market, at which point you can load up as long as it's within your supply and demand area. So here it's about 46 days to expiration. Should the SPY hit a target of, like, let's say 280, like I said, that $80 risk becomes $400 or $500 should that have been your target. Any other combination, you could lose a lot more than $80, or you can gap down on the stock, so the market could close and you could free fall overnight, and then you can still get stopped out at your $100 stop. But if it opens $1,000 below, you're going to get filled at the next best price. Selling a vertical put, which is what I actually usually do, selling vertical put spreads for the SPY doesn't usually make a lot of sense in my opinion, which is kind of what we saw before, where most people will sell the put below the desired area of control and pay to wait, but then you're missing the entire move up, which then seems kind of silly to me. And so that leaves us with buying a call within the move we're expecting, and only then will your maximum risk actually be that $88. So even if you were to do something like Forex, in the Forex market you can get slippage, and I'm in California, so the London session is usually when a lot of the activity happens. I love Forex, but you have to be really, really good at price action, which I actually am. But for someone who's just getting started and they just want to risk something like $88 on a SPY move, because they like, something like the mastermind grid session, move, you can still partake in that move from 250 to 275 with your desired risk, as long as a call that is out of the money fits that range and gives your proper risk reward. So if your trade plan, like we saw earlier, one of the formulations was no less than 4 to 1. So $88 to make 500, should it go to 280, fits more or less that like 4 to 1, 4.2 to 1 risk reward ratio, in which point you can actually take the specific trade. But without the trading plan, that we had developed earlier, you wouldn't even know to look for something like this. And that's kind of what can become, you can get caught in a rat race of even following a classic trading plan that tells you do not, only risk 1% of your account for 3%, but you still don't know how that might fit in your broader goals regarding your retirement accounts, replacing your income. So that's kind of what I mean. Even when I say like memorize to forget it, like I'm a big tech trader. I love to trade Apple, and you know, large cap companies or different cap companies, if they want to buy back shares, they couldn't do it in the first 30 minutes of the day or the second 30 minutes of the day. So once I know my core rules, like I know core strategy, I understand the framework in which the conscience of the markets that I like to follow, how those rules apply to those markets. So how does core apply to Apple and even the Nasdaq futures whenever um, if Apple's doing share buybacks, we're gonna see those implications, um, in the opening of the market, or the last 30 minutes of the market, the first 30 to the last 30, and then the NQ is gonna react accordingly. Because if Apple, for example, um, couldn't buy back their own shares, which is something that they're notorious for doing. And again, that's something about like understanding the markets that you trade above. Um, above and beyond the core strategy rules and frameworks that you live in. um Understanding that something like NQ, the Nasdaq, even if core strategy is true, well, how does something like a tech company like Apple buying back their shares, how will that affect the NQ contracts? So just to recap, if you were trying to retire by age 65 and you want to pay yourself $100,000 a year upon retirement, and you currently have $100,000 in your 401k, your wealth account, to close the gap of $1.9 million over the course of the 20 years you're expected to retire from now until the day of retirement, you would, if you were going to only use $25,000 of your current savings or capital, which is 25%, your end of your still target value would still be $108,000 to close that gap a year. So your target profit for the year with the 25K is $93,000. And if you're going to trade 222 days of the year, and you basically have a daily target of $422, you're going to trade all days of the year, only risking $100. Your risk reward would be 4.2. And that's pretty much it. So essentially, and this is not even on a compound basis, guys. This is just non-compounding how much you would need. It will become increasingly easier as you trade profitably to close that gap at a compound basis. But essentially, in the course of 20 years, you will need to make $442.30 a day, with the current parameters that we talked about, to close that gap. So when you think about 442 a day, considering the leverage you get in stocks, options, futures, and forex, compared to 1.9 million, it seems that much more feasible. So hope that was helpful, guys. So now that we kind of can wrap or try to wrap our hands around that a little bit, and again, you're not going to understand all of this in a 20-minute video, just like you're not going to trade, just like you're not going to be a doctor in 20 minutes. You have to be realistic too. I think trading investing is also one of those things where it's so accessible and the barrier to entry is so low education wise. Even if you're spending tens of thousands in education, you're still not going to pay as much as a doctor. But a doctor devotes or a lawyer, almost 8 years sometimes plus to get to that. But people don't understand the financial markets in 10 minutes, and then they're pissed off and they want to move on. Like, that's not realistic. And I think that's kind of where people cheat themselves. Like, if you take shortcuts, you do get cut short, because I do think trading investing in such a low barrier to entry with such a massive reward, the people that can sometimes, their expectations can be out of touch than versus a professional practice that knows it takes work. But now that we've seen that, now you need to know your personality type. So let's say that you trade futures. If you're risk adverse, and let's say you're just starting trading, if you're risk adverse and it's benefited you. So being very conservative with your risk you're happy with that. And your schedule's 9 to 5 and you're trading for passive retirement income, buying options based on that kind of personality type would best suit likely those needs. If your risk adverse has been a challenge for you and it's something you want to overcome, like I said, I'm a big proponent of life coaching. Is probably the best thing that's happened for my trading, because I think the psychological aspect is the hardest part of it. It's you need to overcome that if it's something you want to overcome. And for that, Forex might be the best one if your account's also under 2K because of the way you can position size Forex. And you still get exponential leverage. So basically, my best friend and I can take the same Forex trade and she's only risking $1 per pip and I'm risking 10. We're trading the exact same move. But, with stocks, you need 25K to day trade them like that, and you only get a 2-to-1 or 4-to-1 leverage. Futures doesn't give you that kind of low risk universe in the world of futures. So then it would be Forex because you can start to overcome those things that have been holding you back, and then hopefully eventually evolve to trading futures and overcome those things. If risk adverse has been a benefit and it's active income under 2K, it's also Forex. So even if you're deciding and committing to futures, and again, I think the goal, like I'm a big Ray Dalio follower, and the goal is, I think, to master all the asset classes so you can make money no matter what the market conditions are. You can have options in a beta hedge scenario on the longer time frame or non-directionally, and then be in high volatile environments like we are now. You can trade the Forex daily moves for income and then having options positions for the monthly moves and getting paid while you wait that way versus getting paid while you wait, risking $400 to make $100, how most people trade options, which is really bizarre to me. But you can begin to kind of formulate based on those different things and your personality and your goals what you should be trading even within one universe. Treasury futures or crude oil or NASDAQ futures move very different. So there's some everywhere in between. So I hope this video was helpful. Let me know if there's anything I can do better. It's something that I'm really passionate about because it's something that I had to figure a lot of it myself. Even in my option strategy, I invested in my education and then I had to remaster it entirely, but there was a genius in that, and I've done something that no one has thought about as far as I know, even the largest hedge funds and managers that I've talked to. So everything I do about options and how I trade them is completely almost opposite to the way people are taught, and the risk reward profile is so much better, but there's a lot of fluff. So that's why I think going from you don't know what you don't know to knowing you don't know to knowing that you know to then knowing that you know and then forgetting knowing it so well that you forget it to understand the consciousness of the framework and the rules of the world you live in. That's what I was able to get to, and that's why I'm so passionate about like the baby steps and reverse engineering the entire process, because you might be a better options trader than I am, and I don't want to take that away from you, but you need, and I think in trying to force feed very specific rules, it can take away from a person's ability to be the best they can be, even if they're making a lot of money in those rules. Again, so that depends. If your goal is to make a lot of money or retire, that's going to be that great. But if your goal is to be the best trader in the world, or to be to just grow and develop through the financial markets and find yourself in the financial markets and what ticks you and what are your fears and anxieties and how to overcome that and all that, then reversing your goals, know what your plan is, know how to get there, know the rules, memorize the rules, trade the rules, make money with the rules, but then find yourself in the consciousness of the framework of crude oil futures or or options or Nasdaq futures. So I hope the video was helpful. Sorry for the ranting. I know I do that quite a bit, but there's just so much that I know that it's easy for me to go on rants. But anyway, guys, I hope that was helpful. If you like the video, please like, comment, follow, subscribe, whatever. And I will see you guys on the next one. Have a great rest of your day. Happy trading.